Everyone, welcome to another episode of the Index Podcast, where we come together every couple of weeks to discuss on-chain data, chart crimes, and metrics that move the crypto industry. Today, I have with me Denning, Chief On-Chain Sleuth at Pantera Capital.
Hi, everyone.
Ruizhe Jia, recovering trader and assistant professor at Stanford University.
Hi.
And I am Boxer, and I am the community powers at Dune. Before we start, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We're acting independently of our respective professional roles. And with that, hello, welcome. Very nice to have you here. Thanks for coming on.
Yeah, Ness, thank you for having me. It's a pleasure.
Maybe, first of all, like how do we get to interview assistant professor at Stanford? What's the area that you're kind of covering within your research that kind of like led you down this path?
Yeah, for me, it's so I kind of do two things overall. But pretty much like some a little bit self-advertising. I think I kind of look ahead like 2 5 years, what still matters. I think there are two things still matters. One thing everyone knows is AI, agentic AI stuff, but it's not what we're going to cover today. And then the second part is really like I see that we're still going to build a lot of DeFi stuff on programmable financial infrastructure that's going to make our financial system way better. So a lot of my research is on this area, broadly blockchain, DeFi, programmable financial services on those infrastructures. And that currently including the new assets where market will introduce like perp market, prediction market, prop AMMs, and also we look like how we finance those innovative ideas, like how crypto VC works. Why do some of crypto VC also do tradings? So we also look at a few other things like pre-IPO perps and all those things and stablecoins. So we really think that blockchain-based financial infrastructure, which is programmable, which is coherent, which is composable, going to be very big. So we want to put a lot of effort as a research group to study that.
Okay, wow. Yeah, but maybe I forgot to say, today we'll be talking about the 5-minute Bitcoin price market manipulations on Polymarket, as you recently kind of did a research piece on this. But maybe first, like, what's the faculty that this is kind of hosted under? Like, where does one, like, in which department is this hosted so you can do all of this research?
Oh, so I'm at engineering school. We have a department called Management Science and Engineering. So we have people like me do finance, fintech, financial engineering, like diffusion model for finance. We have great faculty do entrepreneurship strategy. We have great people do essentially applied math. We call operations research, which is about stochastic network optimization. So it's kind of really great colleagues. Kind of we do all kind of different things. We have a lot of synergy here.
Yeah, I see. And maybe just personally, how did you find your way into the world of crypto?
That's a long journey. So the first step kind of you have to have a good roommate. So I had a interesting roommate when I was at college, and I think one day he just say, "I like CryptoKitty, I like Ethereum, and I wanted to build some Ethereum mining farms." And I didn't take him seriously. I went to Columbia for PhD. I didn't join his kind of huge agenda of mining a lot of Ethereum, and that's why probably I'm a little bit FOMO right now. And then after that, I didn't think blockchain is that useful until during, I mean, even after ICO, I didn't quite like it until when I really see there are people do DeFi on top of that who program something that just is so cleanly and easily do things that rely on so many intermediary in finance. And then so starting with AMM stuff and then MEV stuff. So I kind of really like it. And I was also pretty bored during COVID. And then just start doing research on that as a PhD student from 2019. And then all the way until I'm about to graduate, kind of had to find a job. So, and then FTX collapsed. And then it was pretty bad then. But then there was, so I was doing quantitative trading then at a quantitative trading firms on their crypto desk in Bahamas. So it's also an interesting journey. You kind of do a lot of more from the trading side. How do you from like investment to like to other way to market making and trading. So it's also like kind of eye opening, like how things really work. And then after all those experience, research, trading, kind of decide to go back to academia doing fully all in on programmable financial services. And then that's kind of my journey.
Okay, wow. We have an actual quant on the podcast. I guess
The only quant.
it's. I think recovering quant would have been the better tagline for the intro, but we'll get it right next time. But maybe so. You did some research on the 5-minute Bitcoin price markets on Polymarket, and kind of like I think there's a few key findings. Maybe if you could just kind of like introduce the concept of these 5-minute Bitcoin price markets, and then kind of like, okay, what did you research, and then what are the kind of like main takeaways from this?
Yeah, I think let me actually just pulling out that market. I think that's kind of the best way to show you how it works. The easiest thing you can click into is this thing just jumping around with like all the money floating around. That's what we're gonna study. So you can imagine what happens is every 5 minutes. So there is a 5 minutes window. At the beginning of that 5 minutes, there is an article telling you, oh, that's the price, Bitcoin price at the start of this window. And then we keep track of this price. So this is the orange line. And what people are betting on is whether this orange line is going to be, or this price is going to be higher or lower than this beginning price. So you can see like it's kind of lower right now. So the chance that it's become up, which means that the orange is going to be beating the gray one is going to be low probability. And then so people are really betting if this orange line is going to be ending above or below this price target. So that's the 5 minutes up and down market. We have 10 seconds left, and we can see the chance of this orange line going to be above this threshold is going to be lower and lower until it settles. So after everything times end, orange line is indeed below this price target, then we think the price is down. So people who are betting up lose all their money. People who are betting down actually earn $1 per bet. So like it's going to be a 0 and 1 outcome. And every 5 minutes, you can see this market kind of just start again, right? We start from a new price target. We're trying to figure out it's going to be up and down, and people are betting around it. And you can see there's an order book clearly that you can see people are making market around it. The spread is pretty tight, and people are there's some liquidity which you can actually just send a market order and take all of them. And kind of one thing you should know is what is this orange line, right? Danny asked me this question when I first talked about this market with her. This orange line is actually from different prediction market use different orange line, as you can imagine. And Polymarket specifically use a Chainlink oracle, which is here. If you click here, you can see this oracle. It's really traded price of different spot markets for BTC and USD. So I think that kind of explains how this market works and how people are just betting around it. And the current odd is around still 50-50.
Who the hell trades these markets? Why, before we go into the research, like why would anyone choose this, and what other financial instruments are maybe similarly structured to this, or what can you kind of like best kind of like draw as a comparison in TradFi to this?
I think for this market, you can imagine it's a binary outcome. By binary, I mean either you get 0 or you get $1 for each thing you bet. So it's called binary option in traditional markets. So like then you can think as an instrument. So traditionally, I think there are 3 type of people, right? There are market makers who see, oh, if I just market make here, I collect some spread, I don't lose too much money from all kind of sharp players. I'm pretty happy here. Sometimes there are also deals between market makers and the platform so that they get some additional incentives for doing that to kind of bootstrap liquidity. So you can think there's this type of players hanging around there. Either they're for the incentive or they're for the money. But then for the traders, right, you can think there are people who are really sharp. They think they really have an edge in the market, but you can think they constantly beating the fair price, the price currently showing in the market. It can be because you are someone who are really quick. You see the article before someone else, and you can send order very quick. It can be because someone you have very predictive signal. You don't need to be quick, but you are really looking ahead the future to think about it's going to move a little bit with some probability. Especially you can imagine the more toward the end matters more. But there are some other players who kind of don't make money there. There are some reasons, right? They may have a private reason they like to gamble. You can think that also happens on traditional options. After 2020, the traditional equity option just blew up. Like you have so many retail people trading on that. I think definitely there are people who really like the feeling of betting things up and down. And you can double, even if you start putting your money at the beginning, you can double your money, right? That's a lot of payoff, a lot of volatility in 5 minutes. And also, if you buy something which is only worth maybe 5% probably in that flip, you have 20 times payoff. So it's kind of like really high level bet within a very short period of time. And you don't get liquidated, right? Not like in perps, if you have a 50 times leverage, you can get liquidated before like the 5 minutes end. And there are some players maybe like they're just really think they do have an edge. Like they just think, oh, maybe I can tell the Bitcoin up and down better than someone else, but they actually are not. So they thought they could make money. They're here for making money, but actually don't make money. So eventually there are four people to me. Like there are people who actually market make, provide liquidity, either to we call farm the incentives. We're actually trying to like make the market and like by trading make money. And there are people who are really sharp. They're really just doing like both taking and making, but they really have something we call alpha or edge to make them beat the rest of the market. And we have the third party, like they kind of just go there for gambling reason to experience the short-term vol, and they know they probably don't make money, but they're here for the trade. And there are fourth people who thought they would make money, but they were just wrong, and they just keep losing money. So that's the four people I would say on this market. Sorry, it goes pretty long, I guess. Yeah.
No. That's I've always seen these on the front page of Polymarket, and I've also wondered like who's the target audience for this. But essentially, you're saying there's definitely a retail trader population that's like using these markets to essentially just gamble or like trade, quote unquote. Because like what, how reliably can you really? Yeah, it is definitely kind of very short-term trading. There's no fundamental investment you can make in 5-minute intervals. But okay, so
prediction, but not much fundamentals in 5 minutes. And you can imagine if it's like 5 seconds, the shorter the horizon, the more likely your trade pretty much decide everything, right? So because your trade affect the price on traditional market. So like, but I think that goes pretty far. Yes, and also like people argue that prediction markets for information for like hedging, like we're gonna hedge with a 5 minutes up and down market, not much, I think.
Yeah. You know what? That was kind of what I was trying to get to. Is like, is there any sophisticated use cases that you would be aware of where like I can kind of like build a trade between like whatever opening a 20x long on on Hyperliquid and then going like I don't know short on the 5-minute prediction market? Is that some kind of like? Is there some kind of strategies to be had there? Or like, have you heard about anything like this?
So like one thing you can imagine is because the payoff is binary, right? Like either you're up or down. So imagine when you're very close to that midpoint, which means a slight price up and down will give you a huge payoff difference, right? So in a sense of if you can tell in the next few hundred milliseconds or a few seconds, the price is going to have actually 70% probably going to going up, then your edge is quite a lot, right? Like maybe like 20% of edge. And that's actually very, very rare because you can imagine traditional financial market, the absolute size of your alpha is pretty much capped by how much price can move in that period of time. And this binary discontinuity make that, so people who have a very short-term information on the price or the flows can actually put on this information on Polymarket in this binary option that have higher payoff. So like in the very, very ideal scenario, you can imagine some people who are really sharp about the price in that specific horizon may want to express that view on the Polymarket. But I think even that the view is going to be leaked out anyway in a few seconds, a few minutes. Is that really going to be any benefit to the world? I don't know, but there is definitely a strategy to be played. But overall, I would hope that Polymarket tell us something. I don't know, either is information very private, or like people have very different view of market's aggregation machine to tell me what on earth that probably really should be. But this market probably don't tell me much.
Yeah, like Polymarket as a truth finding algorithm for humanity does not really work out. Like the marginal usefulness of this seems very limited. But okay, so now that we've understood these markets, is there any more questions you have for the like understanding of the market, Stanning?
No, yeah, that's summarized.
So maybe now tell us about the research you did, and maybe like what's the headline finding of that?
Yeah, so I think let me just share a graph. So think about this, right? This is prediction market. We just saw the liquidity on that market. It's like a few $1,000s on the first few like level of the limit order book. It's a rather small market. It's not that as big as maybe Bitcoin spot market, Bitcoin future market. So that's kind of things we want to think, right? But even like it's such a small market, it can affect bigger market. So that's kind of the big picture I want to show you. Like you have this prediction market, but then at the end of the day, it can affect the bigger financial market. So prediction market actually can lead to make people have incentive to affect the other markets. And specifically this one, right? I just show you that this chain link is the one that tell people if the price can be up and down in the end. And then also in crypto, there is a pretty lead and lag. Not all exchanges are independent, right? It's not like I source price from 50 exchanges, they're all independent. There's a lead lag. Typically, you can think Binance price is leading a lot of other exchanges, and if price move on Binance, other place follows. So you can see the gray line is the order flow, or how much people trade every 5 minutes on Binance spot. So the gray line is before Polymarket. So you can see there's some seasonality every minute. People do trade a lot in the beginning of every minute. But the moment this prediction market 5 minutes contract is introduced, where their price is going to be settled here, then you see there's a huge order flow comes in, right? So you can imagine the moment we introduce this prediction market contract, we observe a flow just trade before the settlement period of time. And also you can imagine like this is the price can move a lot more compared to before this contract. And also you can imagine that because there's a new flow, the market has to react to that. So the last one is on Binance, how market makers are putting limit orders on the limit order book, which means that the more they put, you can think, at least in that moment, the more liquid the market is. You can see people intentionally put more size on the end of every 5 minutes. So there are actually a tick up of the liquidity here. So like let's just summarize a little bit. There's this such small market, prediction market, people bet on Bitcoin going to be up and down. The moment you have this market, the price that the Bitcoin, this contract settled on, which is typically other centralized spot markets, suddenly have a flow at the end of that settlement. And that flow is actually leading to, so that flow actually you can see actually make the market a little bit more liquid. And after that, I also want to show you that not only that, you can also later show that this price change is going to be revert really quickly. So it's really going to be a jittering up and price quickly revert. So that's kind of the headline result. The moment you have this contract, the spot market starts to change. There are flows and there are people putting more liquidity. And that flow quickly revert.
At Pantera Research also did a study right around the time this week about short-term market. And then when I learned about this manipulation from Ruizhe's research, I added a bunch of like illustration here. So on the screen, we're looking at basically like a diagram to explain how this whatever settlement or like manipulation that might be happening, like based on observation or evidence that Ruizhe saw on Binance Market. So if someone who's trading on this 5 minutes Bitcoin market on Polymarket, they might speculate that the price will not move much within the 5 minute period, and they might already get into a position of like betting the price going to be go up, and they will keep monitoring the price. And if the price was just below the price target at the beginning, they will buy it on Binance, so to push the price up. And then because the chain link is reading from centralized exchange price, which Binance as the most possible guess as the main source of this price, will be now showing that the price actually got up. So this person going to profit from this position, if that makes sense, even though the natural actual price would have been below. And what they do is like they sell right after on the market. So they kind of like didn't really have much cost in terms of like really pushing the price, besides the fee and the spread. But yeah, this is like basically a formalization of what we have seen and guessed how this strategy can happen based on evidence from Binance.
So maybe if I repeat this back in the layman's terms, after like there's a Polymarket, it ends after 300 seconds, if my math is correct, and during essentially the last 2 seconds of this market, the spot price of Bitcoin on Binance, which is the most liquid trading venue for Bitcoin usually, will actually in some cases spike up because traders are kind of like manipulating the market in order to win the Polymarket market. Like how should I think about this? Like, and is it on every instance of like, does this happen often, or is this like kind of only in like however many markets is there in a day? 24 times.
Yeah, it only happens in a fraction of time. It doesn't happen every single bet.
Yeah.
So I hope that answered your question. And the first part, your explanation is perfectly correct.
So now my mind would jump to there's sophisticated actors that are essentially looking at the Polymarket, being like, okay, how many shares of No can I buy for what amount of money? And then how much does it cost me to move the Bitcoin spot price up on Binance for like this fraction of a second? And maybe it's even a market maker themselves. Like they would, of course, have a kind of easier time to make the price go up in that amount of time by either pulling orders or, I mean, others seem to be providing more liquidity, which that seems a little bit, that's interesting to me. I would like to know why that is the case. But is that kind of like, is that your first assumption as well? Or like, is there anything kind of like if you dig deeper, there's like something more even more sophisticated going on?
So there are a lot of things in the details, but I think you get it mostly right. People put on positions, right, on Polymarket as much as possible, depends on liquidity. It doesn't have to put on position in the 50-50. It can put on position when things already seems very unlikely. You see that happens a lot. So there are a lot of incidents we find that the odd where the price already like, hey, the market is over, is already 90% going to lose, but they still manage to buy things and flip it back. But or eventually the market flipped back after a flow on Binance. We don't know who is doing that. So I think there are many details, and we also see like, when do you think you should flip the market? The easiest one is always when it's at the boundary, right? Because you pay a little bit more, you can let the market move in your favor. So you see more instances of that at the end of 5 minutes. If the market is like hovering there close to the kind of the threshold. So there are many details. If you're interested in, for instance, like people manipulate more when it's close to we call it strike, like it's the threshold we're talking about. We see that the price quickly revert, just like that inside people buy and quickly sell it back because like they don't want to hold Bitcoin position for what reason, right? Like they're just here to put the price up. And they don't happen every single cycle. It happens a fraction of that. And whenever it happens, you see an abnormal flow on Binance, you actually see that the price is very likely to, or the Polymarket very likely to flip to the one that used to like unlikely to win become the one actually won the market. So you can see all those details. The only thing, Yeah, I hope this answered your question in a large scale. But this is kind of the kind of the bad things of this happening is not only like there's some subtlety going on, right? Because first thing you say you're very puzzled was why the Binance market become more liquid, right? I think that's the first thing. Do you want me to pause here, or like you think I should go ahead and
No,
explain?
I would love to know why the Binance market actually.
So like, so think about this. If you are making market on Binance, what's your P&L look like? How kind of like who you're making money from, who you're losing money to? Do you have a like what do you think?
I honestly, I have never really thought about the operations of market makers, so
Yeah, tell me
any
what you
any
think.
of my guesses will be pretty bad.
Will you lose money to market makers?
I think you think, well, you're making money from people. So if I sell, let's say the market is like currently it's $5, and I'm charging like a $1 spread, which means I'm happy to sell at $6, happy to buy at $4. Let's say whatever coin it is. So if you're like casual buyer, like a retail person, there's no kind of you're not very informed in the way like whatever the market's price is, you just come here and buy. So like for you, expectation conditional your trade with me, like I don't think the market can move against me. I think when your trade $5 is $5 and you're paying $6 for that, I'm collecting $1, but $1. So like so you're earning money from people who are uninformed. Let's say this is like what Danning coin, like $5. But then let's say Danning gonna like destroy half of the coin and Danning knows that. And she can just come here and buy from you at $6. She can buy a million of them. And then the thing is, the market when the market knows the information, then it's going to destroy half of her coins. The price can go up, very likely. Then, or Danning has a deal with, like, say, some institutions, say Danning coin can be used for you can buy things from it. Then the price can go up. So the people who are informed for all kinds of reasons, maybe they're good at predicting the price from some statistical model. Maybe people kind of see the Bloomberg news Danning coin going to do something. People who actually is standing who are insiders, they kind of all are more informed than a market maker sitting there. Like then conditional I trade with you, it's not because I just want to buy Danning coins. I know Danning coins is worth more than $6. I come here and buy, and every single thing I trade with you, you're gonna lose money from that because I know Danning coins is worth $100, and you're selling $6 to me, you're gonna lose $94 from that. So in the market maker's perspective, I earn money from people who kind of have no idea where the fair price is, just trade with me, where they're just happy to trade whatever their price is fair in the market. And there are people who kind of know, oh, the market gonna move. I'm gonna just we call pick off for sniping their market makers. Okay, so that's kind of a mental model I want to put in your head. Then think about Binance, right? Binance, Bitcoin. You have people who are really sharp. Gonna buy Bitcoin. I want to avoid like trading with them, so I'm a little bit worried about trading with them, so I don't put too much liquidity there. So that's my worry. And I do want to put more liquidity there because like, oh, there are some retail who just gamble on Bitcoin and so on, or some institutions who are not very careful about their execution. Then I'm happy to put some liquidity there to capture the spread there, right? So or capture some other information or so like there are cost and benefit. And then this Polymarket thing comes, right? There are manipulators who doesn't care about who doesn't even think about where the Bitcoin price is going to move to after that 5 minutes. All I care is I'm just going to buy at the 5 minutes to push the price up. I'm going to be selling into the market in 5 minutes later. So which category you're going to put them there? I would put them into the person who are not very informed because you can think about that. When he trade with me, he's going to trade price up, so he's going to pay me a lot of spread, which means he's going to pay a lot of execution cost because he actually wants to push the price. He actually wants to pay the execution cost. And then he's going to quickly sell into the market. So if I quote very timely there, he's going to actually like sell into the market so I can collect the inventory back in a few seconds. He's going to pay me twice the spread. He's going to pay me a lot of spread, and he's not going to give me any inventory constraint. It's not like I have to hold some risk. So it's like the best trade I can ever make from my perspective. It's like just like trading with people who are worse trading in some sense. And then that's why I would love to provide liquidity to those people. And that think about Binance market maker's perspective. When you see those people come in more and more, why don't I just put more liquidity there and not too much, not too low, because if I put too much, then they don't come, right? If I have too much liquidity here, they cannot move the market, they don't come. Not too small, then I can still collect a lot of their trade compared to my competitors, but then they'll push price higher, I'll collect more spread. And I should have other strategy to make sure that I get rid of my position after this thing happens, to collect also from the other flows. So there are like, you can imagine then from market maker perspective, it's a good thing. Let me put more liquidity there, not too much, but to kind of capture the value there. I hope this answers the question.
So
it's
guess
it's the market makers reacting to essentially at the end of every 300-second window when there's I think you called it strike earlier, when the strike period or the strike time comes up, there's traders in the market that have an incentive to buy Bitcoin basically at any price, or not at any price, but like they have an incentive to push the Bitcoin price up, and therefore they're, for that short period of time, they're price insensitive because they have an incentive somewhere else that kind of like voids the money that they would lose in the execution, and I can get them on kind of both sides of the trade. Once when they buy, and then on the other side when they immediately sell their inventory of Bitcoin again, because they're not actually interested in holding this for any longer than basically the short duration when Polymarket stamps the price. Okay, understood. Do you think this is like do you think the algorithms of the traders just pick this up and just, or like is this a manual adjustment of like, do you think that there's like actually a conscious decision that has been taken to do this, or was this just kind of the machine learning algorithms pick this up over time and then you just kind of like end up with this pattern?
Depends on, I think like when market maker push a new strategy to their algorithm, they're very, very careful, right? There are models, because if you can imagine so many market makers just like, if they push a code wrong, they just blow up. So I think they have internal research backing that there are flows at the end of mechanical flows, and then they understand where the flow comes from, they understand the market structure, and then so that's kind of where their alpha comes from. And for monetization, they think about strategy to play the game. So I think there's definitely human effort to understand how the market, to observe the market, to extract data to see volume are different, and to see they're making money, actually way more money than they do before at that bucket. So the first do trade analysis, and then they should think about why the trade why the market changed, right? And once they figure out why the market changed, how to play the game become more obvious. Then you just have to monetize that uninformed flow. And what's the best way to monetize that? You can do some simulation or backtesting, and then adjust your strategy around that. And then you can monitor and see if that strategy still print money, or people stop manipulating, you should stop.
Does any of you two know how much the open interest for these Bitcoin 5-minute markets is? Is that like an area that somebody has researched before?
I think it's been changing a lot. It may be in the paper. So I would suggest people to download the paper, but it actually have fluctuated a lot, because if you can see, we kind of hide in paper. In Polymarket, there are different period of time. Sometimes they give incentives, sometimes they change fee structure, and that all affect their the volume and then the open interest. So I think I would say the number is probably in the paper.
I quickly pull up this dashboard from Paradigm, but like you can see the total crypto market open interest is 22 mil. Bitcoin is 11 mil. So I'd imagine like if the 5 minutes Bitcoin price is even more subset of that, 10 mil ish. Although we do know that like the 5 minutes is almost like 80-90% of the whole market, at least in terms of volume.
And also the open interest here like kind of get destroyed every 5 minutes, and they have to rebuild it. So you can imagine the total number of money being due around probably is not well captured by OI. It's more like volume and some mix of OI and volume.
Yeah, at the end of the day, if I role play this and I'm the trader that, or like I'm the actor that is trying to, buy no shares on Polymarket, and then push the price up on Binance in order to win with the no shares that I've bought before, then my total winnings are kind of capped by the size of all open positions, right? Like Polymarket in their by its definition or by its internal logic, there needs to, for every yes share there needs to be a no share, and for every no share there needs to be yes share, and together they will always be $1. So like, let's say whatever the price is currently at 80.20, where like I can buy the no shares for 20 cents, and then theoretically I can stand to gain a 5x. So like, what's the amount of no shares that are liquid on the market and like that I can actually gobble up in order to then kind of like go to Binance, push up the price, immediately sell my Bitcoin again, but then I've profited from the 5x I can make on the no shares, right? So like that's why I think like the open interest, like that's essentially then like, how much money do I even need to like push up the price on Binance for like these few seconds, and like I don't know, like how much risk am I taking by doing that? Like how likely is it that the quote unquote real price, I think we've had this discussion a few times where it's like, what even is the real price? It's really hard to say, because usually Binance is like the how do you call this, the like venue for defining like the global price, right? Like everyone else kind of like arbitrages against Binance. So like, yeah, a lot of like kind of multi-factor system, I don't know, like a lot of stuff is going on here.
So
and it's very hard to
I think what you're saying is, if you think you're a manipulator, right? So manipulation costs money. You have to go there and buy something. And if you think about, if you can only buy one share from Polymarket, it's not be worth it. So exactly. So the liquidity on Polymarket really matters for manipulators. And that's probably the reason why you don't see, and why there is liquidity. There have to be some people, market maker has to make a market. And remember that our mental model of market making, there have to be some people subsidizing the market because manipulator makes money, right? So like there has to be some people who are retail people who are losing money. So that's why I think I think you're exactly right. The liquidity depends on how much benefit or how much position you can put on, and that depends on whether it's worth it to manipulate. And also there's a strategy layer, because you see a lot of time the price flipped at the end of when things are already like, I think 90% is going to be down, but then suddenly flip back. So, and then you can imagine people are happy to, when things are 100% down, there are strategy, people are just selling tails, which means they sell like, hey, it's already 90%, it's not going to happen, let me sell it to you. So you can imagine that manipulator can target on those because they can source a lot of liquidity, and then they can also have a much higher leverage, right? Because if you buy something at 5 cents, if you win, you get 20 times payoff. So this may make the tails slightly more expensive or less liquid. So eventually, it's always a game playing between how much size you can source on prediction market and what's the cost of manipulating the market on Binance. Because you can imagine when liquidity more and more, people realizing that it's going to be harder and harder to manipulate unless the Polymarket can scale up with that. So maybe this trade may be not profitable after some certain time. So I hope this can help you to crystallize things a bit.
Yeah, in a way, the way I understand it is that like if you think about the profit of a strategy, there is the profit that you can get from the Polymarket, which is related to what you mentioned, which is the liquidity or how much open interest are on the opposite side. And like the bigger it is, the more attractive it is to do this manipulation strategy. But at the same time, your profit is that revenue minus the cost, and the cost would be how much naturally the price are drifting away from the target price. And in a way, you also see from like Ruizhe's paper that basically like this is very prominent on 5 minutes market, but not so much on 15 minutes market or 1 hour market or 4 hour market, simply because the price just drifted away. And so it's going to be more inventory to push the price, and more likely there's a higher cost of the spread, if I understand correctly.
In the paper, we actually realized exactly as you think, right? Manipulation costs money. And when the price is, say, is $500 different from the target, it's very hard to manipulate. It costs a lot of money. So you can imagine this happens a lot when the horizon of this window goes longer, because price move everywhere. So many more people trade in the longer horizon. But then you can think in a very extreme, if every time the Polymarket said not only 5 minutes, but maybe 30 seconds, 20 seconds, 10 seconds, then if you have enough money, pretty much maybe in that 10 seconds, it's all about you, right? It's only your trading. So it's much easier to manipulate, and the price doesn't change much naturally in that 10 seconds. So it's pretty much all you. So in the paper, like one remedy, as Daniel says, if you just make the horizon a little bit longer from 5 to 15, then very likely there's way more we call price discovery, way more other people trading in a period of time. Then at the very end, at the settlement period, is already maybe not very profitable for people to manipulate because the price is so far away from that strike or threshold or whatever you call it. So that's one thing. And also like one thing, like kind of like interesting thing, like Boxer understanding, like do you think Polymarket market makers happy or unhappy about manipulators?
You're saying Polymarket market maker, not the
Polymarket.
Binance market maker.
Polymarket, some Polymarket market maker. What do you think?
I guess depends on if they're in the manipulator side or the opposite side.
Yeah, I feel like, so I think, let's say they just make the market there, trading with them.
Probably is losing more than they should.
Actually, I think they may be happy. So, do you want to know why?
Yeah, please.
So, like, there are some very interesting here, which is, so we saw that Polymarket bet, right? Like, it's like 50 cents to buy up and down, right? So, but then you can imagine two type of players are buying that. One is the manipulator we're talking about. One is people like me or Danny, right? We're just buying up because we thought maybe it's a fair bet, 50-50, right? So what's going to happen is you can see that if Binance people see there's a huge buy on Polymarket, they're going to think that they're going to be manipulation in about 5 minutes, right? So they're going to put more liquidity there, and after the flow kind of goes up, they're going to sell into it, right? So they're anticipating manipulation flows if there's Polymarket buys, and they'll try to sell into the flow, right? But the manipulator doesn't come every time. It comes like maybe 40% time, 30% time. So even you're just standing who want to buy a lot up, the market maker will thought you might be a manipulator, so they'll still push the price down at the end of the settlement period. So then you thought you're buying up, you get a 50-50 chance. But regardless, but the moment you're buying up, the other side of the market may think you're potentially a manipulator, let's push the price slightly lower, then eventually your chance of getting up is only maybe 40%, 30%. So the fact that you're mixing with manipulators make your direction less likely to be profitable. So in a sense of, like, people cannot tell if you're a manipulator or not. Why don't we treat everyone as manipulator? Why don't we push price down, make the up like less likely to be settling up? So in this way, as a market maker, you're pretty happy because people who are buying up, they thought they're doing a 50-50 bet. But at the end of the day, the chance of things going up is only like 40%, 30%. So market maker can be happy because they're selling you a contract that's worth more than it's worth. So eventually, like, as a retailer, you're unhappy because you thought like, oh, up and down are 50-50. But when you put a lot of side there, actually, like, no, like, you only get 40% chance of being up.
That's assume the market maker is aware of the manipulator's presence.
Yes, but now you see the liquidity goes up, the price get reverted. So now it's kind of very obvious the other market is respond to that, right? So when you respond to that, you put more liquidity there, then even a true price flow comes in, they'll not be able to push price high, right? So in other way, like, even a true information comes in, they'll hit into this barrier of liquidities. Even when the price are supposed to go up, they can be harder to go up naturally. So like, as someone betting up, you're sad because even like there are flow to make it up, it doesn't go up as easy as before because they think manipulator may come and buy even more. And this is just sad to you. But when it's sad to you, the people who are trading against you, which is the market maker, are happy because Danny's buying something worth 40 cents with me, paying 50 cents. Sorry, this is some subtlety here. part of the paper, but it's very I like it this very a lot. So like it doesn't hurt only market maker who don't care. It hurts people who actually just put in casual bet, like they think they have a chance, and also like then the probability also not be going to be very accurate anyway.
I think we've had a lot of negative sentiment here against these market and the manipulators. is there any positive thing that we might be able to say about this? I mean, you said at the beginning of the podcast it provides some information, but that information is mostly useless. But maybe it doesn't make markets more efficient in some kind of way, or does this really just introduce kind of like a very weird arbitrary incentive to, I don't know, steal more money from retail or whoever is like active in these markets?
So I think there are maybe Danny and have more comments on that. I think so. First, prediction market is very large. We have prediction market that offer information, offer gambling segment that other market cannot offer, right? No matter it's information or so those ones are going to be very useful. And there are still a lot of going to be design questions around that, right? How do you avoid manipulator and so on. So Polymarket overall prediction market, I do believe is going to be bigger and bigger, and they have true welfare gains for people, no matter from information or from other things. But for this specific market, I actually don't know. Like, why do people even need to bet on Bitcoin price up and down in the very short horizon? Like, who can possibly hedge with that? And there is not a very clear path for me to make this even useful. And to me, it's a transfer machine from people who are uninformed to informed. And we can make this less severe. We can, Danning says in my paper, and also like you can. So there are two ways to fix it very easily. You can make the horizon long enough. It solves that 90% of the problem, and you can make the oracle like a little bit more like TWAP, VWAP. The harder, like the more information the oracle takes to decide the price. The harder to manipulate, but then you can imagine like if you take a longer time, then the things are pretty much decided even before the settlement, right? Because if you're doing a 6 seconds TWAP, then at the 50 seconds, pretty much all the up and down are kind of decided. So there are pros and against. But overall, I think for your question is, we can kind of in the paper give some instruction how do you get rid of a little bit more of these negativities. But on the other hand, like you kind of really have to pitch to me why we need this market. So far, it's very, very unclear to me.
I mean, Polymarket needs to make revenue somewhere.
Well, I mean,
Nasdaq are trying to do it on stock, like stock indices, like SP 500. Nasdaq is trying to do that, and Cboe also have one trying to do something like that. So, like, sure, exchange has to make money, but why do we need that instrument? I have a.
Like, I mean, why are people trading it? I think that's the like. Why do we need sports betting? Why do we need, like, I don't know, why do we need anything? I think like if there's a market for it, like I think like it probably has a good right to exist. Of course, like from a like purely logical or like does this make the financial system more efficient? Apparently not. It actually introduces some like weird noise that now everyone else needs to be aware of and kind of like model out of their decisions. And actually, yeah, it makes it more complicated. But I don't know. There seems to be a lot of computers like battling each other in these markets and doing like very, very, very strange things of like between Binance and Polymarket and kind of like trying to hedge their their short-term Bitcoin exposure between this market and then like whatever spot exposure or leverage exposure they have. So yeah, I don't really know if it makes anything or like I literally have no idea if it makes anything more efficient. But I don't know. It seems like one more financial instrument in the toolbox of all the financial instruments, and whether it will survive over time, I guess that only time will tell.
I'll show you one thing. Why this exists. Have you guys done tap trading game before, where you can bet and get the instant?
Okay,
is
this
that
question
fun?
is it illegal to trade this in the US?
Yeah.
Okay. Talk to your lawyer before you show up.
This is the extreme version of the 5 minutes, and there are people building it and people playing it.
Was this on chain or was this off chain?
That one was on chain, yeah, on Hyperliquid.
Okay. Interesting. On
Yeah.
hyperliquidity. Oh, wow.
Like to me, then I'm a big believer of perpetual futures. I think we're gonna see perpetual future entering the world and have way more footprint than this Bitcoin up and down market. And so is prediction market. We can see the prediction also going to evolve. The market structure, how do we make sure that, like, prediction market is one way to aggregate information. People are paying for the information to show, but people have to have incentive to bring information to the system. How do we design it better? You can see already there are, on the Pantera, Danny probably know more than me, like, you can see people doing all kind of innovation prediction market, like let's do a RFQ, which is required for code. Let's do a private one. So like, and also for perps, like perpetual future, perpetual options, and whether that bring to the US. So I think we're in a time that we're going to see more and more, like Dr. is like new instrument, as you said, and many of them going to be washed away by the just intemporally. Some people make money, some people lose money. But in the long run, I think we're in a time that many of those innovations will stay. We're going to see a lot of new things. And I think that's the best time to do a lot of research.
Yeah, exciting times to be researching this stuff. I certainly didn't know anything about these markets before, and now I know a lot. It seems like there's probably like 20 actors that are really kind of like doing a lot in these markets. And if you could just talk to one of them, you would understand so much more. But just looking at this from the outside in, like, it gives you like a very like limited view of whatever they're actually trying to do. Because like I would really like to know, like, what other exposure are they trying to hedge out with this? Are they trying to hedge out as an exposure? Are they just kind of like an MEV bot, just extracting like, okay, I see there's an opportunity to, like, with a like probability of 80%, I can probably move the price in my favor and buy like a lot of no shares at the same time. So like, let me just do that. And that's like what MEV bots did for the longest time, right? They're just like, okay, if I move like the money through like 20 different pools, then I can gain like $30. So like, let me just go and do that. And like, if I have to flash loan $3 million for this, I don't really care, because like at the end of the day, like all of this, on like EVM systems, like everything settles in one transaction. So like it's a no risk activity. And like I would like to see the internal systems that like these traders are running in order to make those decisions. Like it's probably, I don't know, just interesting stuff. But yeah, I don't know. Anything else you wanna leave us with?
No, I think Ruizhe says, yeah, it's I think that you're touching one point, which is how do you get insight in this space, right? A lot of time you have to get your hands dirty, observe the market, where you can play the market. For example, like, so that's why I think we should let people play and figure out. For example, like what you said, like you can talk to people, you can also make a bot yourself, and those things are extremely helpful to understand how things really work, or even just think of it as a player, not thinking as this is just random number.
Yeah, like the crypto market has been just up in the horizon and like been growing like crazy. And we started the year when Polymarket was leading this category still, but now like Kaoshi is printing 15 mil in fee per week for these market. Yeah, they have like 550 million volume in terms of like one side volume, the taker volume per week. So I don't know, like this is the printing machine for all these markets.
Yeah, Danny, I also feel like this market, I think Boxer and Danny, like maybe this is a good end note in a sense. There are so many other things as regular to look at. I think about Polymarket is like off-chain matching, on-chain settlement, and then Kaoshi is just pretty like just centralized, and there are other prediction market. It's a lot of like things you don't know. Like in the matching engine, do they give people more advantage, and how Kaoshi print that 15 million? Like how do they give people rebate as market makers? I think those things needs to be crystallized. People should know that. Like if there are incentives that are bad, people should know that. Like how does those on-chain machine really works? Like how market makers are playing the game? Like do we get a fair bet any single time? I just think there are so many things we need to know and we have to know, and they don't tell you naturally. And as a researcher, we have to figure things out from the this seems to be wrong type of perspective.
a call for transparency, much appreciated in our data podcast. We love the data. Please bring it up. But yeah, thanks so much for coming on. This has been quite insightful. I think many questions have been answered, but almost as many questions are now starting to open up. And I guess further research will show what the true nature of these markets is, and maybe like how there's so many open points of discussion. But anyways, you've listened to the Index podcast. Thank you so much for coming on. Thank you for listening, and bye.
Crypto data wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar, we call them out and set chart crime on fire. Index podcast, crypto data empire.